Hi everyone. In today's episode, we are talking why I sold Exxon Mobil. We're going to go over several factors into my decision. Firstly, we're going to talk about their financial fundamentals. So we'll talk about things like their assets, their business models, where they're planning to go in the future, and overall, if I think they are financially set up for success. Secondly, we'll talk about the future of the energy industry as a whole and understanding ExxonMobil's position in it. And then we will also talk about my overall dividend portfolio and how I thought it fit into my dividend portfolio or how I didn't think it fit into my dividend portfolio. So we have a lot to cover in today's episode, and we'll get started here. So as I began my research on whether or not I should sell ExxonMobil, I came across two articles that were very helpful in helping me make a decision. One was bullish in their position and one was bearish. I will actually link both articles in the description section below. So this first one talks about Exxon and how they don't expect them to be someone they're not. Basically, what it talks about is that Exxon focuses on fossil fuels, so oil and natural gas in particular. And this person thinks that the prices will return for those and that adequate demand will be there. And what Exxon likes to do is essentially they're very good at figuring out supply and demand, right? They figure out where the supply of oil and gas are, and then they make sure they can get it to the customers who are using it. And this article really focuses on Exxon being probably the best at what they do, and how there's probably going to be enough demand in the near future to make sure that they are stable. So while I agree that they're probably the best at what they do at figuring out supply and demand, I disagree with the premise that there will be significant demand or that the demand is growing, right? I think the demand is what it is, and I think renewable energies is a bigger competitor than what ExxonMobil is doing, and they aren't well positioned to switch into that industry at this moment. And if I'm looking at like a 3 to 5 year timeline for stocks that I think will just grow and I don't have to do any active investing in them or management of them, then I wouldn't say ExxonMobil fits that description. So this article is a little more bearish on Exxon, and it talks about treading carefully. It really gets into the financial aspects of the company and four particular metrics. And so we'll take a look at those. First is production, right? So it looks at production, and this is a yearly graph here. And you can see it's mostly stable, slightly declining, which is probably something you don't want to see. Overall, you want to see probably an increase in production. Either that indicates that they aren't able to find supply, which I don't think is the case. There's just more likely that there's not demand and they don't want to overproduce, which is what we're seeing right now in the current pandemic. The second chart here talks about revenue, and you can see that our revenues are going down consistently. These last 2 years are forecasts, right? So this is 2020 and 2021, but overall you can see the revenues have been decreasing steadily. This typically is more of a measure of price than anything, right? So even if supply is stable, if the price or demand is stable, if the price is going down, then you're going to see decreased revenues. So that's not something that indicates a growth industry. The next one is earnings per share, right? So you can see their earnings have really just kind of tanked here in 2020, will probably be negative, but overall has gone down, consistently throughout the years, the past decade. And then more importantly, and what concerns me the most, and we'll get into this in my last section, but is their debt, right? So their debt has been increasing. You will always see large debt in industries like oil and gas because they have to fund all of these assets, and they have to just spend a lot of money to find the oil and gas resources. However, I think a lot of this debt is actually being used, particularly right now, to cover their dividend. And so I think that's a risky sign. So I think this article does a good job of summing up the financials, but I don't want to take that on just faith alone. So we will look into actually Exxon's 2019 annual report, where we can look at specifically the numbers that they report and what it looks like year over year. So if we look at this overall financial statement from their 2019 report, we can see that Their net income has gone down, right? So again, this is mostly probably a function of that revenue that we just looked at, right? So from 2018 to 2019, it's gone down significantly. These are millions of dollars, so that's about 6 billion. It's gone down 6.5 billion. Cash flow again has gone down. That's not something you want to see either from operations and asset sales. Capital expenditures has gone up, so that means they're investing heavily, even though they are making less money, which is not always necessarily a concern. In these, again, you have to spend a lot of money in this industry, right, in order to be the biggest company there is. But I think given their income, that shows that management is deciding to still spend heavily, even though their revenue is decreasing. Research and development has been mostly stable. Again, you want this to be a percentage of either your income or cash flow or something like that, and so it's up even though their revenues are down, which is concerning. Again, this most concerning row here is this total debt at year end. I think the total debt jumping up by almost 9 billion, or right around 9 billion. I think that's concerning. I think when you are having to lose money and you're losing revenue and you're trying to make up for it in debt, that is never a good situation. And if it's something that continues over time, as those charts were showing us, that's concerning overall. So fundamentally, I think these are concerning and red flags. Overall, you can see their valuation hasn't really changed. Their share price hasn't really tanked or anything like that. It was kind of at a peak here in 2017, but relatively stable from 2018 to 2019. The other piece I want to look at, right, is this dividend and shareholder return information. We'll get back to this chart in the last section, but just take a glimpse here. And I think Exxon, what they did in this report is they kind of give all of the positives here, and they're missing a couple of metrics that kind of hide their results. So if we look at this section of the annual report, it kind of gives insight into Exxon's lines of business, right? So upstream is essentially the supply, right? This is all of the areas where they are finding supply for oil and gas, right? They show kind of unconventional, deep water, LNG, heavy oil, and conventional. Downstream is essentially how they sell it, so meeting the demand, right? And that's either through fuels or engine lubricants, things like that. And then they also have a chemicals division, right? So this gives a pretty good view of their lines of business. I would agree with that first article we talked about, that they are very good at what they do. So we can jump to another slide in this annual report that will show exactly what they're doing and how they're meeting demand. So as you can see from this chart here, and this is actually 2015 energy demand, it gives a graphical representation of demand across the globe and by region. So particularly China sees a huge demand in India, right? This tends to correlate with population if you look at the countries that are labeled here. But overall, I think Exxon has a very good ability to identify where there is demand and potentially growing demand, and how to meet the needs of those regions. If we go to the next slide here, you can see their projections. And this is, again, where I disagree with the projections that Exxon has here and what that first article was saying. So you can see they have 2040 projections of oil and gas and coal and other types of energy. And Exxon is showing that they are, going to be in the dominant fields here of oil and natural gas. That's where people are headed towards, they believe, in 2040. Particularly, they see a big increase in natural gas. I think while this is somewhat accurate, I don't believe it's entirely giving the true picture. I think oil and gas, yes, they will probably be the most used fuels in 2040 or in the near future. However, I don't think these energy sources here at the end, so nuclear, wind, solar, hydro, geo, and biofuel, particularly solar, wind, and biofuel, I think will be higher in 2040 as we move towards renewable energies. I think this is as people become more educated on climate change and just the abundancy of these energy sources compared to the limited resources we have, and the difficult and the expense of trying to find new resources in these three particular fuel types. I think people will start eventually shifting to this. And so long term, I think the industry will actually be more heavily biased to this, like in the super far future. But I do think, in the near to immediate future, again, Exxon is well positioned in these two fuel types. So What you might be saying is, well, if you think they're well positioned and they're able to meet supply and demand, why would you sell this stock? Overall, I think it's more of an issue of financial management. So you have decreasing sales prices of gas on the consumer end. You also, I believe, will have decreasing demand in the two main fuel types that Exxon specializes in. You also have increased expense in being able to find that, right? So that goes back to the financial statements we saw where they're increasing in spending while they're losing in revenue. That's never a good combination. And then lastly, we'll get into this in the last section here, is the ability to cover their dividend and dividend safety. So if we come back to this slide on dividends, which has dividend and shareholder return information, you can see dividends per common share, dividends per share growth, right? So this is a dividend growth channel, right? I advise all of you to, or I shouldn't say advise, but I would highly suggest that you look at dividend growth stocks. And so you can see Exxon has been a dividend growth stock. They've grown their stock for a very long time. We'll jump into some Seeking Alpha data in a minute here, but you can see the jump from 2018 to 2019 is 6.2% dividend growth. They're also talking about how many shares outstanding they have, and then just total shareholder return, right? So overall, this would make their stock look pretty well suited for dividend growth and just a general pretty good return in 2019. Now, I think in 2020, we'll see the shareholder return go down quite a bit, and then the growth will be another question, right? But they have been consistently growing for the past few years. I think management takes it very seriously that they need to maintain their dividend and grow it. However, let's jump over to the Seeking Alpha data to show something that is missing from this report. So if we jump to the dividend section here of Exxon Mobil's stock ticker and look at dividend safety, this is my primary concern with Exxon Mobil stock. So you can see that their payout ratio, which is missing from their annual report, is 130%. That means they are having to borrow money in order to pay out their dividend. You can see their cash dividend payout ratio, right? So this is cash to dividend, right, or dividend to cash, essentially, is 584%. That's okay, I guess, but when you have a payout ratio of 130%, that's somewhat ridiculous for it's not sustainable, right? And then you have this long-term debt to total assets. It actually looks really good, right? So this is, you're like, well, we just talked about how much debt they have. Well, yeah, they have a lot more assets than they have debt, and their assets, are huge assets, but if you think about this, they are not able to easily sell those assets, right? People have to be willing to pay the price that makes sense. And so if they need to start paying down this debt for some reason, say a pandemic, for example, that where they see decreased demand across multiple industries, and they needed to start selling these assets, it would be very difficult to do so. Actually, one of the Seeking Alpha articles that we mentioned before talks about how Exxon's been trying to sell assets since 2014 and are just having trouble selling off a lot of their assets. More importantly, you can see this is what concerns me as well, right? So this net long-term debt to EBITDA ratio. So remember, this is earnings, essentially. So debt to earnings is 72%. That means most of their money is going back to paying debt, and then you have this dividend that keeps growing every year, and they're having to borrow money essentially to pay out that dividend. So it's very concerning, right? Because I think their dividend is not very safe currently, and I think at some point they will either have to cut the dividend or continue to borrow money at worse and worse interest rates. So right now interest rates are super low. It's probably easy for them to borrow money, but in the future, and I would say not too far off, I think this dividend is at particular risk. So hopefully you guys learned a lot in this video. I think to summarize, I think there are issues with Exxon's financial fundamentals, right? So their ability to control their spending, even though their revenue is decreasing, and you remember the trends from the past decade doesn't look so hot. I think the second piece is the future of energy and where it's going. I don't think Exxon is particularly well poised to move to renewable energy sources. They are very stuck in fossil fuels. They do it very well. They are able to meet supply and demand very well in those particular fuel types. But any other fuel type, I feel like they are not well suited to adjust their business rapidly to that as demand takes off in those areas. And then lastly, I think for my dividend portfolio, it's just not a great fit anymore. Overall, the payout ratio is super high, and the debt is also concerning. Actually, before we leave, let's look at M1 really quickly so you guys can see what happened with my M1 account when I sold those stocks. All right, so you can see my activity for the past week here and what happened with Exxon. So Exxon actually paid out my dividend on June 10th, $11. It's actually one of my highest dividend payouts in value because I own quite a few shares, and it was an overall good dividend, right? Their yield is really high. However, after seeing all this research, I decided to sell Exxon Mobil. So I had $623 in Exxon Mobil in this passive income stream account, and you can see what I bought instead. So M1 does this automatically based off of the percentages, but I did increase percentages for several of the companies so that it would auto adjust to buy a higher amount of AbbVie, Microsoft, and I believe Lockheed Martin, right? So I think those three I wanted to increase my percentage in just based off of their growth rates and their current yields. And you guys can look at previous videos on how I do my monthly evaluations on increasing or decreasing percentages or deciding to sell certain stocks. So you guys can see directly what I did, why I sold ExxonMobil. Hopefully this is helpful to you. Leave a comment below or feel free to email me at statelyinvesting.com or tweet me at investstately. Just let me know, what do you think about ExxonMobil in particular? Any other stocks that you guys are thinking about selling, even though they might be great dividend growth stocks? Let me know. Hopefully you guys got a lot out of this video, and I will talk to you again next week.